Hello and welcome. I'd like to thank everyone for joining us for today's webcast, When Will China Lose Its Low-Cost Edge?, hosted by IHS, the leading provider of diverse global market analysis, economic insight, and commodity intelligence. My name is Rory King, and I'll be your host and moderator for today's event. I'd like to begin with a few instructions for the audience. We'd like to maximize your experience today by making this an interactive event, so feel free to ask questions at any time. You may ask a question by submitting them through the Ask a Question area to your right and clicking Submit when done. The slides advance automatically throughout the course of the event today, and if you need any help, you may submit a question or click the Help icon at the bottom of your screen. Our expert technical staff will try their very best to resolve any issues you may be experiencing. Please note you may join the conversation on Twitter today. Follow IHS using the handle @IHS_supply-chain and follow along using the hashtag IHS Webcast. Note that that's IHS Webcast, singular. Today's webcast is the second installment among a series of webcasts being hosted by IHS titled Supply Chain Thought Leadership, Best Practices in Strategic Sourcing and Procurement. Be sure to join us for our next webcast on January 9th, 2013 Steel Buyer's Guide, Where Are Prices Headed? Our senior IHS economist, John Anton, will share the steel forecast for 2013. So be sure to tune in for that. And finally, your feedback is extremely important to us. We'd like to ask you to complete a short survey about the content of today's event and other issues in sourcing and procurement. The survey can be found at the bottom of the webcast console via the survey icon. Please take a moment to fill it out. And IHS is offering everyone who completes today's survey a chance to win a Samsung 2 Galaxy 7.0. You may need to disable your pop-up blocker if you're unable to view the survey. And now for today's presentation. Today you'll hear from Laura Hodges, Director of IHS Pricing and Purchasing Service. Laura covers the analysis and forecast of global labor and healthcare costs at IHS. She received her MA in Health and Labor Economics from Duke University, as well as an MBA from Rutgers University in Beijing. Laura has worked at IHS for more than 15 years, where she has been helping clients identify the most cost-effective and efficient actions for procurement of key materials and services. And with that, I'd like to hand things over to Laura to begin today's presentation. Laura?
Thanks, Rory. I'm actually very excited to be here with you today to discuss when China will lose its low-cost status. But before I get going, I wanted to say a few words about IHS. I know I have a fair amount of clients on this webcast today, but others in attendance may not know anything about our organization. A brief description may help frame today's discussion in a better light. IHS delivers the data analysis and expertise primarily across the sectors you see listed here to help corporations and governments make better tactical and strategic decisions. The information that I'm going to draw upon today is primarily from two units of IHS, our Country Forecasting and Risk Service and our Pricing and Purchasing Service, which Roy just mentioned is where I'm from. First, our Country Intelligence Forecast delivers the economic, business, and investment climate for over 200 countries worldwide. And this provides the supply and demand backdrop for our price and wage forecast that you will see presented here today. Additionally, the Risk Service constantly monitors and updates our clients of the key political, economic, tax, legal risks of operating in these same 200 countries. Secondly, our Pricing and Purchasing Service falls under our Commodity Price and Cost Division. And this service analyzes, forecasts, and tracks commodity prices and manufacturing costs for procurement managers around the world. We aim to deliver data and analysis to help our clients make more effective buying decisions, estimate project costs, assess supplier quotes, and negotiate long-term contracts. We ultimately help our clients make better buying decisions and hopefully save money along the way. To go into a little bit more detail on our pricing and purchasing service, it uniquely delivers pricing data and analysis across the entire supply chain, from energy to aluminum to machinery, and therefore allows us to analyze prices across the entire manufacturing cost perspective. More specifically, we examine price movements by breaking down production cost by labor, material, equipment, energy cost, and supplement this cost picture with the supply-demand dynamics that can influence price growth over time. For example, we can pinpoint the reasons for a price increase for construction machinery. Strong demand from emerging markets has certainly provided upward price pressure, but we can also tell you that a 10% price increase from steel prices should lift machinery prices by between 2 to 3%. The advantage of this approach is that we deliver a framework to analyze price change, and this framework is actually going to come handy later in this presentation when I evaluate if and when China will lose its low-cost status. So let's get started with the real question here. So why the concern about China? The recent studies have suggested that China has or will lose its low-cost status over the next 3 years. The Boston Consulting Group came out with a paper last year that predicted China will lose this low-cost battle in 2015. A deadline we know is rapidly approaching. Meanwhile, through conversations with many of you on this webcast today, I'm getting the sense that many of you are just now reaching your comfort level with the Chinese quality for the products and materials that you're buying from there. So should you be concerned with this potential shift from China as a low-cost country? For those sourcing in China, on the positive side, labor costs are rising rapidly, but they remain low and productivity is high. Also, shipping costs are at low levels. On the negative side, the renminbi continues to appreciate and will move stronger in the coming years, making export more expensive. Further, I'm going to hopefully convince you that there's no real cost advantage on the material side for operating in China. The bottom line is that for low margin, low value goods, the low cost run may be over in China. So today we're going to discuss each of these factors in more detail. And then I'm going to walk you through a case study involving steel castings to illustrate the potential China cost savings compared to the U.S. for this product. And along the way, suggest a framework that you can use in your own organization to evaluate the potential or lack thereof cost savings for the products you are buying overseas. Going back to the question of should you be concerned about China, I think this slide will show you that if you're not, others around you and certainly on this call today are. Here are some of the results from a recent IHS survey about sourcing and supply chain risks. From this survey, I want to highlight 3 questions that point to the changing dynamics of today's supply chain. The first one, which of the following regions does your organization plan to increase sourcing and manufacturing to the most in the next 5 years? Asia Pacific Rim, excluding China and India, grabbed about 40% of the vote here. No surprise. As we move through some of these slides, you'll see that this is home to some of the low-cost countries that I'm going to highlight today. China second, 37%. I think, yes, people are still looking to source, but you'll see a recurring theme throughout this presentation that it's going to depend on the type of good that you're sourcing from. And the U.S. actually comes in third at about 35%. The U.S. was a surprising choice, but not if you're really reading the headlines today and thinking about the changes in the global marketplace. Shale gas here in the United States has dramatically lowered natural gas prices and has brought more chemical manufacturers to put U.S. investment plans back on their books. The global risk environment has meant substantially lower costs for operating closer to home, where you can monitor things more closely. And if you just peek ahead to reason 3, you'll see more evidence there, or question 3. And finally, the U.S. does have one of the most productive labor forces in the world, lowering the unit cost of production. So taking it on the flip side, question 2. Which of the following regions does your organization plan to decrease sourcing and manufacturing to the most in the next 5 years? European Union, 30%. High cost, lower demand expected in the future, no surprise there. China, we're going to dive into a few reasons why in question 3 at 21%. And U.S., a little bit contradictory to the first question, but I think, again, we need to look at the type and mix of goods that you're potentially decreasing or increasing sourcing from to get at the true answer here. So question 3, what is the primary reason you plan to decrease your presence in China? Of course, there are many factors that go into a sourcing decision, but here I want to highlight the 3 from our survey. And these were the top 3. Diversify suppliers and operations at about 40%. Move to lower cost regions at about 31%, directly in relation to our conversation here today. And a distant third at about 15% said move operations closer to home. So people are certainly moving their sourcing centers. And how we can help make this decision is the purpose of today's presentation. But first I want to take a bit of a deeper look at China's economy and their evolution over the past decade and see if there's some potential other factors that might keep us operating and sourcing from China regardless of how this cost look paints out throughout our conversation today. So first, here you're looking at the share of U.S. nominal merchandise imports by country, with China as that bright orange line staring at you. Just a decade ago, our 3 major trading partners, Japan, Canada, and Mexico, made up more than 40% of U.S. imports. Fast forward 10 years later, 2010, that share has dropped 10%, mostly at the expense of Japan, who has seen their share cut in half from about 12% to 6%. Meanwhile, that orange line just goes up. China's share is more than doubled from about 8% in the year 2000 to just under 20% in 2010. China became our largest trading partner in 2007 and has increased that share ever since. Next slide. Whoops. So further, China has also played a larger role in our global supply chains. Over the past decade, a larger and larger share of materials are produced in China, as you can see in this chart. China has produces almost half of all steel production, up from about 17% in 2001. Similarly, just over 40% of base metal production, including aluminum, is produced now in China. And finally, almost 60% of total cement production is made in China. China has truly and rapidly emerged as a manufacturing powerhouse over this past decade. And just to name a few additional milestones of China, China overtook the U.S. as the world's largest car market in 2009, and in 2010 passed Germany as the largest exporter and surpassed Japan as the second biggest economy. And I think you'll see as no surprise that by 2020, China will take over the top spot as the world's largest economy. And looking at these 2 pie charts, you can see just right immediately of just the dramatic evolution that China will continue on despite what we just painted over the past decade as well. China in 2010, we're taking that as roughly right now, represented about 23% of world GDP. Sorry, U.S. did. U.S. 23%. China at 9%, and India at around 3%. And more importantly, if you look at the developed world, if you look at the pie, the portion of Japan, Western Europe, and North America, essentially making up the developed world, in 2010, that made up about 60% of world GDP. Fast forward, and you now have the developed world share dropping to under the 50% mark, again represented by Japan, Western Europe, and North America. Specifically, U.S. is now 17%, and meanwhile China and India have more than doubled their share just over this decade, from about 20% in China and about 5.5% in India. So needless to say, the U.S. drops from its top position and China takes over. Further, you can see that China's advantages may have turned from a low-cost destination to the largest market in the world, meaning a few other reasons of why you want to operate in China. So let's turn back to our question about low-cost China and take a look at the 4 factors that I mentioned on my first slide. Overall labor costs are still very low. So despite this tremendous growth we see in this country's economy, the average Chinese manufacturing worker still earns about $2.50 per hour. That translates into roughly $3,000 per year in base pay. And this is after a 12.5% annual growth rates over the past decade. There has been strong upward pressure both in the past and looking forward, and these are the elements that have really contributed to that strong pressure. Minimum wages are increasing by more than 20% annually in some provinces of China, and the government has suggested a 13% annual increase through 2015 to support the domestic economy. Shenzhen is just one province down in the southern part of China that has already announced another increase for 2013. I think it's around 13%. Inflation is another factor. It's risen above, it's at points over the past decade above the government target with higher food and energy costs. And while inflation is not necessarily a problem right now, food and energy costs are sure to remain a pressure point in the future. Productivity gains have pushed 10% higher annually over the past decade as well, allowing employers to increase wages without necessarily increasing prices to their customers. We'll get into that on the next slide a little bit more. And it goes without saying that worker demand is extremely strong. Unemployment remains near 4%, and worker shortage, particularly for the right type of skills and for the coastal provinces, this has been reported. Now, I do reference a 2.5 average manufacturing wage, but in a large country like China, this can certainly vary by province and occupation. I generally think of wages on the coastal cities as double the average that I've quoted here, so roughly closer to $5 an hour. And many report paying professional workers in China the same as Western or U.S. standards. So obviously the disparity is wide across this country in terms of not just the location but also the occupation. So all of this pulled together, we do expect many of these forces to still exert upward pressure on wages. We expect them to double over the next 10 years and will grow another 10 to 15% annually over the next 3 to 5 years. I will note, though, given the recent economic slowdown, in this year and next year, we expect wage growth to be on the lower side of that range and picking up as we move closer to 2015. So productivity. I want to dive into this one a little bit further because I do think this is one aspect, a forgotten piece to consider when compiling the complete cost picture for manufacturing. And it is in this case that it shines in China's favor. And to illustrate what I mean by this, imagine that wages, and in fact this is a true situation, imagine that wages increase 15%, but productivity increases 10%. That translates into a true unit cost increase of really only 5%, reducing the total cost burden for manufacturers for manufacturing the good and, of course, paying the worker. And this is really the case for China in itself. The productivity gains have been extremely strong. Look at 2011 in this chart. Here we're looking at real manufacturing output per worker. And in 2011, it's roughly $42,000 a year. That's pretty impressive given an average wage level of just $2.50 per hour. To put it in perspective, current output per worker in South Korea is near $65,000 with a wage level of $14.50. Thailand, the productivity is around 14,000 with wage levels around $1.70 per hour. And in the U.S., it's like the high benchmark here, the U.S. average manufacturing output per worker is $120,000 per year with average wage around $27 per hour. So I think you can get the sense that for a given wage level, Chinese workers are among the more productive in the world. So moving to my second factor that I wanted to discuss here, material cost. And here I wanted to establish with this set of graphs that there is no material cost advantage for operating in China. In each of these charts, excuse me, you're looking at 4 price charts here of varying units per price. And the China price is always represented by the dashed line to sort of draw your eye to what it really means to China. So whether you're looking at the steel, the copper, the ethylene, the polypropylene, you will see near-term deviations. But over the long run, over the span of this period, which is approximately 10 years, I think you'll agree that prices are more or less in line with each other, regardless of the region that we're pulling it from. This is actually reinforced by the fact that China really has no particular advantage on the natural resource side. So the bottom line here, and one that will come in handy when I start looking at our framework with which you can evaluate where or if your cost structure, your products you're buying have moved off the Chinese advantage, we're going to assume that the material costs alone do not create a Chinese advantage. The third aspect is exchange rate. Here is our exchange rate outlook for several major currencies, including the renminbi. And for each graph, we are looking at the currency relative to the U.S. dollar. Generally speaking, the U.S. dollar has been weaker against most currencies over the past decade. Good for U.S. exporters, but not for those looking to outsource and ultimately bring the good back into the United States. As for the outlook, the dollar is expected to stabilize against the Canadian dollar, the yen, maybe even gain some ground against the euro, but against some major emerging markets, including China, the dollar is expected to continue this depreciation. We've all seen the brief pause if you're tracking exchange rates right now. The renminbi has paused this long-term, or at least since 2005 when they decided to float the renminbi. But we have experienced a brief pause in the renminbi's appreciation over this last year to help stem the export slowdown in that country. But longer term, we do expect the renminbi to continue to drift downward before it stabilizes between 5 and 5.5 renminbi per dollar. This will provide cost pressures for U.S. importers from China. And finally, the last piece of our cost puzzle before we get into our framework is shipping rates. And while shipping rates is always an added expense when you move sourcing or operations overseas, for now the situation looks better than what it was just a few years ago. Here we're looking at the Baltic Dry Index, or BDI, as my proxy for global shipping rates, and is a good global benchmark for the price of moving major raw materials by sea. You can see in this graph from roughly 2005-2008, the BDI skyrocketed up five times its value before falling to almost nothing with the market crash at the end of 2008. However, since then, the rebound in trade and even fuel cost has not been enough to push this BDI higher. And that's because shippers have ordered a lot more ships during the boom, during 2007, 2008, right before the job. They were ordering new ships, which are now just coming online. This abundant supply has kept rates low now and into the near-term future, posing little cost concerns for shippers right now. So as of right now, this is on a plus side for you, looking not just in China, but really to any country outsourced from the United States. So now I'm going to turn to the good, what I'm going to call the good stuff. We're ready to pull all this information together and determine whether China is nearing the end of its low-cost course. Here's an example looking at the U.S. steel casting sector and comparing it to an assumed cost structure for the same sector in China. I choose the steel castings, not randomly, to illustrate this framework, but I chose it because it's a fairly labor-intensive good, making it a good candidate for sourcing overseas. But please keep in mind that this process could be replicated, repeated for any product that you're sourcing from China. So how did I build this framework? I started with the 2010 annual survey of manufacturers that's released here in the United States by the Bureau of Census. That information gave me cost information for this industry for payroll, broken down by production and management, energy cost, material cost, and I supplemented this with our own expertise as well as from the every 5-year survey or census of manufacturers. So we now know that scrap, ferrous shape, sands, industrial equipment, these are all the materials that go into producing a steel casting. So then to be able to move it over to an assumed China cost structure, I needed to make some assumptions, of which I hope I have supported in my previous slides here. I've assumed that material costs are roughly equal across the U.S. and China. Assume that the average Chinese manufacturer is only 40% as productive as the same U.S. worker. And I've assumed, and not really assumed, you've seen in the data, the average U.S. or average Chinese manufacturing wage is only 10% of the U.S. wage. So these assumptions alone have allowed me to go from the table on the left-hand side to the Chinese production cost on the right-hand side. And as a result, our share for labor or payroll has dropped from 30% to around 10%. And of course, conversely, the material and energy share has risen to account for that drop. So adding all this up, the cost column itself actually represents, according to the U.S. Manufacturer Survey, the total cost of production for this sector, $17.7 billion in the U.S. Compare that with our calculated cost structure of $13.7 billion, and that results in a 23% cost savings for operating in China as of 2010. So this is the framework with which I've devised to help me understand whether to move it from U.S. to China. You could also use the same example to move to Indonesia or to Mexico, two countries that I'll highlight in a few minutes, to really be able to understand the potential cost savings of operating in different countries around the world. So the next chart actually, so when will it flip though? When will this cost erosion completely erode? In this graph, I've tried to carry out the cost profile for the U.S. and Chinese casting sectors forward by aligning our forecasts at IHS for prices and wages in both the U.S. and China, and assembled a cost index for U.S., China, and the steel castings industry and carry it forward over the next 10 years. And I concluded that the cost erosion in China continues and that the advantage is effectively eliminated by the end of the decade, at least using this example of cost savings. Now keep in mind a couple of things here. I actually haven't explicitly accounted for shipping cost, exchange rate appreciation, supply chain risks, other factors that can cut into this savings. So while I do estimate a 23% lower cost of operating in China in this example of castings, it's actually lower considering some of the other factors I list here. So why does the cost continue to erode in China? It's effectively that fourth bullet right there. Over the next decade, we expect Chinese wages to move from 10% of U.S. wages to 25% of U.S. wages. So that has effectively eroded our cost advantage of operating in China. Now, while it does still, according to this example, make sense to operate or source in China, it is undeniable, given this example and other information I've presented here, that the margins are narrowing. And you can do this analysis again for the products in your supply chain to determine whether this situation applies for you. But the bottom line is that all of these factors mentioned today is enough to make China uncompetitive for your basic manufactured goods. So if that's the case, where should we be looking next for a low-cost solution? Here we're looking at the average manufacturing wage in 2012 in terms of U.S. dollar per hour. Please note that this is direct wage only and does not include benefit and other labor costs to really employing your average worker. As you can see, China is not the lowest cost country, which is kind of unbelievable given that China is at $2.50 per hour and the U.S. is sitting at $27 per hour for your average manufacturing wage. However, there are still countries that have an average wage less than $2 an hour, including Vietnam, Indonesia, and while I don't show on this graph, we've actually estimated two low-cost hotspots right now of Bangladesh and Cambodia at around 25% of the Chinese wage. But looking again at this graph here and moving forward over the next couple of slides, we're actually going to recommend you take a closer look at two countries. Indonesia, which is certainly a lower cost country than China, approximately around $1.50 average manufacturing wage right now in 2012. And Mexico, you'll see it's on the other side of the cost curve right now, but it is closer to home, so you may be saving on some of those other supply chain risks, shipping costs, etc., that could improve the cost picture for operating in Mexico. So diving into this a little bit further, here we are looking at, again, manufacturing wages for Mexico, China, and Indonesia only now, but over time, in terms of U.S. dollars per hour. There are, and you can see, looking at, I think it's a yellowish white line there, that's Indonesia. Indonesia in 2010 represented approximately $1.50 in terms of manufacturing wages. And by 2020, it jumps up to $3 an hour. While we do expect wages to triple in 10 years for Indonesia, they do remain substantially below the Chinese wage, which is represented in that red line, purple, red. And there's also other attractive features of Indonesia besides the wage cost picture that we're painting right here. The government is currently encouraging corporations to invest in their country. They want to divert from an ag economy closer to a manufacturing source. They've also imposed some significant business reforms since 2004. And because of this, Fitch and Moody's recently upgraded their credit rating. And in the process, they regained their investment status after a 14-year hiatus during the Asian financial crisis back in the late 90s. Indonesia also has an abundant natural resources that may actually produce material cost advantages that we don't necessarily see in China right now. And in addition, they have an abundant labor force. May or may not know, Indonesia is actually the fourth most populous nation in the world. So all of this does roll up to suggest that you take a closer look at Indonesia when making your next sourcing decision. Another story that kind of pulls out of this graph is that you can quickly see that Mexican wages become lower than China by the year 2020. That's in the blue line. So while all of these are increasing, we expect Mexican wages to increase at a lower rate than China, and therefore China to move past them over the next decade. So while both of these countries do look favorable on the cost front, particularly over the next 10 years, no country is without risk. Here, IHS has developed an exporter risk rating that helps provide a complete picture when evaluating a country during your sourcing decision process. The risk scores presented here represent a subjective probability of a range of business risk for a given country, and that number ranges from 0 to 100, with lower meaning lower risk. So what we have here, Mexico, attractive because of its proximity to the U.S., but it does carry some risks. Has a cumbersome bureaucracy, corruption exists, and I think we've all heard about the violence from drugs and organized crime there. It does have a surplus labor, but like many countries around the world, it does have a shortage of technically skilled workers. And despite renewed efforts to make the labor laws a bit more flexible, there is some political resistance to making that fully applicable. Indonesia, like I just mentioned, has made some great strides to encourage investment, but they need some more. It's still the same issues as some of the same issues facing Mexico: bureaucracy, corruption. The reforms on business regulations has also slowed over the last few years. A 40-hour limit on the work week is a comparative disadvantage. And Indonesia's labor force, while abundant, as I just referenced, only 2% of their population is university educated. We'll say keep in mind, though, down in the red at the bottom, that China does carry its own risks, and we currently rate them relatively close to Indonesia at 14 and 23% over the next 5 years. So my last slide, actually. So to summarize the key takeaways here for you as buyers, China will retain its low-cost status, but it does depend on the labor intensity of the manufacturing process. Labor was and is the primary advantage to operating in China, and those costs are rising rapidly along with the exchange rate. Now, while the exchange rate has sort of taken a bit of a pause this year to account for the export slowdown in that country, wages will grow near 10% in 2012. I would recommend that for high labor, low margin goods, start looking for alternative low-cost countries such as Indonesia or ones closer to home, Mexico. But always be aware of the unique risks in each country, and you need to constantly monitor them. To monitor, I would actually recommend our, no surprise, IHS Risk Service for a forward-looking viewpoint, as I pointed out some of the information in the previous slide. Or look to the World Bank's annual cost of doing business survey. It's something I certainly keep an eye on in my analysis of global labor markets. So it's important to keep an eye on these costs and risks because the risks alone can quickly erode your cost advantage for operating in a country. So with that, I'm actually going to remind those on the line on this webcast that are currently clients of our webcast. I have seen a couple of questions pop in related to commodity prices and our outlook of that. We do sponsor a quarterly webcast for our members or clients. The next one will be on Wednesday, December 12th at 11 Eastern. We typically have a variety of topics that we cover each quarter. This time we'll be focused on a similar discussion as this, in that it takes the commodity price slide that we've seen, the decline we've experienced in commodity prices, and put it in context with some of the equipment categories that many of you are buying today. So what type of cost negotiation should you embark on for the equipment category, given the declines in metals, given the declines in aluminum and copper? And so that is pointed as the silver lining for buyers in this next webcast. So with that, I do thank you for your time today. I know that we're going to take the remaining time and go over some questions, but before that, I'm going to turn it back over to Rory and for a few concluding remarks. Thank you.
Thank you, Laura. Extremely insightful presentation, and it's perhaps with no surprise that we have some extremely insightful and comprehensive questions. So with that, we will move into the question and answer section of the presentation. I'll point out that we have just an abundance of questions from our audience, which is great news. And I will say that with the limited time available, I'll point out that many of the questions, or some of the questions as I see them coming in, have been answered throughout the course of the presentation. So it's perhaps wise to tell the audience that the presentation itself will be available afterwards. It will be a recording that you can access later on. So some of these questions, as I say, in the off chance we can't get to them all, or in the off chance that we skip them, given that they've been covered already, they will be available in the recorded version. Also, we have the ability to contact the audience, so if there are questions that aren't answered during the Q&A session and that were not answered during the course of the presentation, there will be an opportunity for IHS to contact those of you who ask questions. So as Laura's taking a look at the questions themselves, I'll point out to the audience that now would be a great time, as you're formulating perhaps your thoughts or your questions, that would be a great time for you to participate in our survey. I would ask you, if you could, it would be very important to us and be very appreciated if you could fill out the survey. It should not take too long, and not only are we interested in the content of today's presentations, we're also interested in some issues going on in the supply chain that we've asked you to take a quick moment to provide your input on, which helps us shape the future direction of these webcasts, as well as the contents of our products and services offerings for you. So with that, we will take our first question. Laura, first question is, how successful will China be in moving its manufacturing base inland?
That's a good question. Many of the clients I talk to are considering that as an alternative to the coastal regions, as well as some other Southeast Asian countries as an alternative for not just sourcing, but also operations. It is a strategy of the government, the Chinese government, to help move some of this manufacturing to the inland provinces. And it does, the current manufacturing is predominantly still concentrated on the coastal regions for obvious reasons. It is an export economy still right now. And so being along those coasts is a relative advantage for operating in China, despite some of the higher labor costs there. Moving inland, there are some advantages as dictated by the government for moving inland. I will say I think that change has been slow. And for those that are looking to eventually export out, you still are going to have the added cost of getting from inland to the coast to then export it out, not only adding cost but also time. So I think generally speaking how we view the move inland, while it will save on somewhat on labor. It will also save on land costs. That's another attractive feature for moving inland. You'll also have some advantages from the government for operating inland, or at least through the different provincial governments. All of them sort of tackle it differently. But I do think that there'll be some movement. But it is in high competition, like I started out this whole conversation with countries down in South and Southeast Asia that are readily at the coast, ready to move out. So it remains to be seen. Right now we haven't necessarily seen a lot of movement inland. But like I said, it is in the 5-year Chinese government plan, and many provinces are certainly encouraging it through tax incentives and other monetary incentives to move inland.
Great. Do you feel, Laura, that the 10-year productivity rise or slope in China is actually sustainable in the future? Maybe will it flatten?
Roy, it's a good question because I think that a lot of, at least in my quick read across the questions here, a lot of them have to do with productivity. And it is a huge issue. It's been one of the reasons for China's success. And another reason, that it will help retain some of the manufacturing in that country relative to some of the competitors I just mentioned in Southeast Asia. The reasons for, first I think I want to evaluate the reasons for the high productivity growth in the last few years, because I didn't mention that in the slides, and then answer the question as to is it sustainable over the next 10 years. I think some of the reasons for the increased productivity is just purely the investment. I mean, the investment that has gone on in China has just been tremendous, and a lot of the facilities that are coming online right now to manufacture are world class. I mean, there's certainly some that are not, but they have a tremendous investment that have gone on in that country that is really unparalleled to other regions of the world. And that has contributed to the high productivity in China. Also, they do, just thinking about the people itself, looking across other regions, other similarly priced or, labor cost countries, they have a very high educational attainment. So this is a well-educated population, as well as, the strong, like I just mentioned, the strong investments have really pushed that productivity higher. Will it continue? Of course not. Similar to what we have our expectations of Chinese growth, economic growth, we are downgrading that a bit. I think the days of double-digit economic growth in China are over. And even the government itself has lowered their target GDP rate to closer to 7.5%. So, with that is going to come lower productivity, less investment coming in. They are going to slow down that ascent forward. But nevertheless, I don't think that the days of relatively stronger productivity growth than what we see here in the United States or elsewhere, that's certainly not over, but it will be slowing.
Okay, you may have touched on the issue of inflation during your presentation, but question here, can you advise us on China's regional or commodity cost inflation outlook over the next 5 years?
Sure, I can. As I mentioned, I don't think that the commodity pressures in China versus elsewhere are any different, so I think I would give our general outlook for material cost moving forward from our pricing and purchasing service. And again, for those that are clients, I would recommend that you listen to our fourth quarter webcast next Wednesday. But I think that right now, we've obviously just come through a huge increases in commodity prices since 2005, really across the board. You look at it, oil, metals, chemicals following the oil price upward. All of these commodities have seen extremely high increases. And while they've certainly subsided more recently, they remain at very high levels. We actually see things until we start to see this global environment, this demand picture really start to recover. Truly the recession's over, but demand is still not there, and it's because of all of this uncertainty still lingering in our global economy. We got the U.S. fiscal cliff lingering over us. We got the EU debt crisis that's still it's not going away anytime soon. We have some questions truly about the sustainability of Chinese growth. So all of this alone, I think over the next 2 to 3 years, I think we see a volatile path for commodity, but overall one that is relatively stable, more stable than what not stable, but that's not expected to increase substantially from current levels. So until our overall demand picture has recovered truly globally, we're expecting commodity prices to remain relatively flat, but volatile from day to day over the next couple of years until this uncertainty is truly put to rest.
Great. Well, we have approximately 5 to 10 minutes left, and just as an indication for the audience, we have well over 60 new questions for Laura, so perhaps this is a topic of extreme interest, and that would probably be a good way to point out that if you could complete our survey, we would certainly love to know if you'd like to hear from Laura again on this topic. Please just take the opportunity to fill out our survey. And also, obviously, we won't get to all questions today, so again, I'll point out that this will be recorded and available after today's event. Laura, a question on other low-cost countries. What particular low-cost countries are likely to be next in line?
That's a question near and dear to my heart. A colleague of mine, Simona Makuta here at IHS, and I recently tried to answer this question at the IHS Forum in Washington, D.C. last month. And the title itself was "Where is the next, what's the next frontier in global manufacturing?" Really trying to get to this low cost, who's the next low cost hotspot. We actually took a different approach and used the apparel manufacturing sector as a guide to where manufacturers like those on the phone would be moving next. So think about it, apparel manufacturers are, it's a relatively high labor content, but in low capital investment. So you can quickly, relatively speaking, move in and out of a country with apparel manufacturing. And it could be a good signal for folks that are looking for that next hotspot to watch. So we analyze, where is apparel manufacturing, where is apparel exports, where is the center sort of moving. It's interesting to note, though, that China still represents a majority of apparel manufacture to this day. It is starting to decline, but it represents over half of the global manufacturing of apparel. In the places that it's starting to emerge are some in the Southeast and South Asian countries, namely Bangladesh, Cambodia. Folks are even debating about jumping into Myanmar. So those are countries where we're starting to really watch in terms of the next low-cost countries. But of course, these countries don't necessarily have the infrastructure for auto production yet, or some of the higher value categories that I know many on this phone are looking at. So these are things to watch, but places like Vietnam and Thailand. Thailand may not be, with some of the extreme minimum wage increases we've seen more recently, may put it on a bar closer to China. But Vietnam is still one that has some very rich production coming out of that also has relatively low wages. So, if you're in the mid-tier, that might be a good country to be looking at, although, of course, much smaller than China. But in terms of low-cost countries, again, the ones we're really looking at are some of the ones I just mentioned. And if you're interested, I would suggest to track, where the apparel manufacturers are moving to capitalize on that next low-cost country.
Great insight. In terms of government incentives, Laura, what incentives are being offered by the Chinese government to companies exporting out of China?
We got this question a couple of times. I think that during the global recession, the global downturn back in 2008-9 period, which really impacted all countries, you saw China introduce some tax rebates, some tax incentives to exporting out of China. This time, while we did see a slowdown this summer, exports year over year slowed down to about 1%, which is a very low level for China, 1% year over year growth in exports. You saw the Chinese government start to get nervous about that, and of course there were some rumors that they might introduce some tax exports. To my knowledge, and of course I checked with some of our experts sitting in Beijing, that collectively in a wide scale fashion, this did not turn out this last summer. The way that they approached it is really by tackling it from an exchange rate perspective, which I mentioned earlier. Not only did they, halt the appreciation in the renminbi, their exchange rate there in China, they also allowed it to depreciate a little bit to alleviate some of the cost pressures there in China and hopefully encourage and keep encouraging the exports out of China, especially over that little dip we experienced this summer. Now, those that are following the renminbi, of course, it has started to appreciate again, and now is closer to 625 from the part where it did halt around 630. So I say they thought about it, tax incentives, but in the end managed to release that pressure from exchange rates primarily, and of course other stimulus plans that they put in place over the beginning of the summer and fiscal policy. So exports and rebates were not necessarily used to my knowledge.
Great. As we move towards the top of the hour, I'll point out to the audience we'll stay a few minutes longer. And as only the host and moderator can, Laura, maybe I can put you on the spot while I say a few more remarks. We obviously have a lot of questions, as I pointed out. I don't know if, Laura, you want to take a quick opportunity to scan some of the questions while I say these last few remarks and see if there's any that leap out at you that you'd like to address as we wrap up here. I want to take the time to point out that I really appreciate and thank everyone who has taken the opportunity to join the conversation on Twitter. We have some great companies who have not only attended and live tweeted today's event, but have actually promoted today's event. Companies like the ID of EA, as well as World Micro and other companies. I appreciate you live tweeting and joining the conversation and following IHS_supply chain. Laura, do you see any questions? There's a couple at the top here. Do you see any questions that pop out at you that you'd like to jump straight to?
I don't see a theme in the rest of them. I mean, I will say that we will get back to folks. I think we do we have everyone's email, Rory?
Yes, we do.
Okay. So some are just clarifications of what I said or in the slides, and we'll certainly clarify that. Others are more detailed questions, which we can take a look at. I will say that this is not necessarily supposed to be the picture on low-cost sourcing. We took an example. We took a few countries to highlight. That's not to say they're not the only countries that could be attractive for your own business. You need to take a look at your individual strategy and product line and make those decisions yourself. But I hope at least everyone will walk away with some better knowledge about the overall wage environment in the global economy, as well as hopefully offer a framework with which you can make these decisions on your own. And with that, I thank you for everyone's time.
Great. Thanks, Laura. You'll see for more information after today's event on the screen, you'll see there is an email address, Webcast, that's plural, webcast@ihs.com, where you can send any further inquiries after today's event. We also, of course, encourage you to visit ihs.com/pricing purchasing for more information, and perhaps for those of you unfamiliar with pricing and purchasing, as Laura mentioned at the beginning of the event, we'd love for you to email or research the offering area further that Laura talked about today. So with that, one last potential opportunity here to complete the survey. That's at the bottom of the screen. There's a survey icon. If you have any issues completing the survey, like I said, that might be related to a pop-up blocker, but simply you may have challenges. If you do completing the survey, just let us know and we'll find a way to make sure that it's possible for you to fill that out. But for the rest of you, great majority of you can fill out the survey by clicking the icon at the bottom of the screen. And we would just really appreciate your feedback and to know what you thought of today's event, further questions you have, opportunities to hear from experts like Laura again in the future. So with that, I'd like to thank everyone for attending today's webcast. It's probably prudent for me to mention, as Laura said, that we see just a great number of our clients worldwide who have taken the time to participate in today's event. We really appreciate not only you attending the event, but of course you being a customer of IHS. And Laura, it's been a privilege to hear from you. It's been very insightful and a very interesting presentation today, so I'd like to thank you. And lastly, as a reminder that today's webcast is the second installment in the series we mentioned, where we're talking about supply chain thought leadership and specifically best practices in strategic sourcing and procurement. Join us again for that series final installment, January 9th, the 2013 Steel Buyer's Guide, where I mentioned that we'll hear from John Anson, who will share the IHS Steel forecast for 2013. And with that, thank you for joining us and have a fantastic day. Thank you.